Hi, welcome back to Trading Hour. Let's now take a deep dive into the credit card market in India. Abhishek Kothari is joining in with an explainer of all the major trends in terms of spends, market share, and also what to look forward to.
Well, credit card issuance growth rate for the month of August on a month-on-month basis has declined, and this decline has come for the first time in last 14 months. HDFC Bank continued to gain market share in spends. The reclassification from RBI led to card issuance numbers being down, especially for the likes of HDFC Bank and Axis Bank. Now, credit card issuance on a month-on-month basis has declined for the first time in last 14 months, down about close to 2.8% month-on-month. So, there is an RBI ruling to not classify those cards which are inactive in terms of 12 months or more, so in total number of cards. Hence, primarily, it looks like it has taken a toll on some of the players. So, card issuance on a month-on-month basis was strong for the likes of DBS India, Federal Bank, South Indian Bank, AU Small Finance Bank and IDFC First Bank, while it was weak for the likes of Canara Bank, Axis Bank, SDFC Bank, Bank of America, Bank of India as well as Yes Bank. Overall spends for the industry have declined by 3% month-on-month. Spends per card, however, have declined by just 0.2% month-on-month, and it remains below May average by about close to 2.5 to 2.6%. Let's take a look how the market share in terms of spends have moved over the last 6 months. So in spends, HDFC Bank has gained market share in last 6 months, while SBI Card has arrested the declining trend for the first time in last 6 months. ICICI Bank has lost massive market share over here by almost 228 basis points month-on-month. So top 4 have seen their market share in spends decline from 74.5% that they had in April 2022 to right now about 73.3% that they saw in August 2022. Market share loss in spends over the last 6 months is seen for the likes of SBI Cards, ICICI Bank and IndusInd Bank. Highest market share gain in spends over the last 6 months is seen for the likes of HDFC Bank, Kotak Mahindra Bank as well as Bank of Baroda. So market share movement for HDFC Bank, it continues to remain the leader over here with a market share of close to 28-29%. And HDFC Bank has been able to gain massively in terms of market share over the last few months. This followed by Axis Bank as well as Bank of Baroda. However, on a declining trend, we have seen market share loss for the likes of SBI Card, ICICI Bank as well as IndusInd Bank in terms of market share in spends. So the outlook in credit card business is that the decline in average spends that continues to be a cause of worry, but it can pick up in the coming months owing to the festive season that we will witness. So RBI has also asked banks to reclassify the number of cards and remove the non-active cards or the cards which have not been active for 12 months. This has had its impact on some of the players like HDFC Bank, Canara Bank and Axis Bank. Card issuances can decline for some in the next couple of months due to this RBI diktat. HDFC Bank is gaining massively in spends market share over the last few months. With festive season coming up, we can expect spends for the industry as a whole to increase from current levels.
Thank you very much for that, Abhishek. With that, it's a wrap on Trading Hour. As we wrap up the show, we leave you with some important market opinion coming in from Kotak Mahindra AMC's Harsha Upadhyay. Thank you for watching this show.
I think India has been a bright spot in an otherwise challenged global economy, I would say. While we have done much better than most other markets in the recent past, the trend also continues. But we need to remember that we can't be immune to the kind of volatility that is likely to be there in the global equity markets. Having said that, I would say that the problems at Indian economy is much lesser as compared to what you would see globally. For example, the negative real interest rates across the globe is much higher than what we are witnessing in India. So to that extent, the interest hikes that would be required in Indian economy would be a lot lesser. So the growth impact is going to be a lot lesser. Even after a couple of interest rate hikes, our economy has been resilient in terms of growth. In the last couple of months, we have increased our exposure to banking and financials. Within banking and financial, it's been mostly large banks because that's where we believe, while on one side you are seeing credit growth picking up, you also won't have the pain of cost of funds going up because there are reasonably strong CASA ratios across the board. Another pocket where we have been adding to has been autos, more particularly in the passenger vehicles, while we have some exposure to two-wheelers and commercial vehicles. But we do believe that passenger vehicle segment is likely to see very, very strong growth. And some of the headwinds that we had seen in the past, for example, the chip shortage or the commodity cost pressures, etc., also seem to be kind of normalizing. So we do believe that these two segments can be our performers as we go ahead. Domestic inflows are a big cushion for our markets in terms of reducing volatility, I would say. But again, even here, we need to remember that last quarter, that's July to September, we have seen a bit of moderation, nothing alarming. The SIP numbers still continue to be growing on a month-on-month basis. We are at record levels now. That continues to be the long-term trend, which also is more sticky. So I would say that quantum should continue giving a lot of support to the market. I really do not see a situation where domestic flows will turn into negative, and that would put additional pressure to the market. That may not happen, but the kind of cushion that we were seeing for the entire October to June period, October of last year and June of this year, maybe a little bit is going down at this point of time.